Hello out there, this is Tackle Trading. My name is Coach Gino with TackleTrading.com, bringing to you another awesome options report for the coming week of March. Here we go. We're going to get into this, but I just want you to know that the market has turned bullish, but we were expecting a little bit of a pullback. So we're going to play both sides. We're going to tell you the bullish team and the bears team. If you go to options report on the options, if you go to the options report on the TackleTrading.com website, you'll see under our bull picks and our bear picks, our entry, our stop, our target, and the strategy I prefer. But just for this video, I just want to go over what I see in the charts. First one up on the bulls team is Aetna, and what I'm looking at here is a major double top going on here. And if this continues to go bullish, my breakout point is posted on our trigger. It's about 110, just over 110, the breakout point. Now, why 110? Because we're going to form a little bit of a cup and handle here, I believe. It might pull back a little bit more, but that's my breakout point to the upside. And our target is going to be somewhere around 116. Now, we're using long calls, but you can use any strategy you want with this. Maybe a bull call spread would be good because volatility in the options is low. The next candidate on the bulls team is ADP, Automatic Data Processing. Same story here, but look at all this resistance up here. Look at all this. And same thing, market's turning bullish. If it continues, we can expect a breakout here on ADP. Again, we have our triggers and stops posted. Where you put your stop on a trade like this is very, very important. So look at where we put the stop on the TackleTrading.com website. Now let's go to the bears team. On the bears team, I like the setup on this one. This is AIG, American International Group. You can see the setup here. We've got our triggers to buy puts down in this area, and the stop above today's candle when you're looking at right there. Also, you can use any strategy you want on this. The option volatility is very low. So when we get triggered on this, I expect a spike on those options. Second one up on the bears team is Monster Beverage Corp. You got the nice downtrend going here. Once again, we've got a trigger just below, I believe it's this candle here, to buy puts. And we're actually doing out of the money puts on this one. Why? Because this has a strong ATR. The average daily move on this stock is well over 2. Therefore, out of the money puts are fine, or a bear put spread. Again, option volatility is low on this candidate. That's why I like it. Last one on the bears team, Royal Caribbean, RCL. Looking again at a possible trigger for a downtrend. What I noticed on this one is the increasing volume as the last 4 days made lower highs and lower lows. Okay, so if we hit the trigger that I want below this candle, great candidate for another short play. My target's way down here, and if you're doing an Elliott wave count, this could be a nice run to the downside. For credit spreads, actually looking at a bear call up in this area on Tesla. We're doing a bear call spread or a bull put, or if you put it together, both credit spreads will be your iron condor. On the cheaper side, all-time lows on natural gas were hit again this week. So if you're looking for a cheap covered call play, you can do this either way. You can buy the stock here on margins, dirt cheap. It's going to be about $3 a share since on margin you pay a half. It's under $6, so even in an IRA account, it's a cheap stock. You can buy hundreds of shares for very cheap. But what I'm doing is to make some quick money on this one and to bring my cost down even more. Selling the at-the-money call, the 6 strike. You could go out a month, you could go out a few weeks. I like to bring in a good 10% return on investment when I do these for quick profit. Now, 10% is pretty darn good. If you don't want to acquire this stock and you think it's going to go down a little more, you could come down here and sell the 550 naked put. That's about 3 weeks to a month out, and that's a 10% return on the naked put. If the stock goes down to 550, you could be assigned the stock and then turn it into a covered call. Either way, natural gas, I do not believe, will go bankrupt, and we're very overstretched to the downside, due for a major bounce. Lastly, the opposite of an iron condor is a debit condor. Domino Pizza had this huge gap up after earnings here, and I'm expecting it to start. Now, volatility's dropped quite a bit. I'm expecting it to pick a direction, either fill this gap, that's what I believe it'll do. It'll fill this gap down here somehow, which is a good 7-8 point move, or after it starts to consolidate here, maybe break to the upside even more. My prediction is it'll probably come down here and fill this gap. But to play both directions, you can really cheaply buy a put spread and a call spread at the same time. Now, buying both of those, if you're doing the spread that I'm putting on the post on the site, it's really cheap. We're getting into the spread well under $2 total for both sides with a max profit of $5. So net, we're risking about, let's say, just under $2 to make a profit of $3. There's well over 150% max reward versus risk. And this goes all the way out to April. So a real cheap way to play an expensive stock. Well, thank you guys very much. That's another options report. Again, this is Coach G from TackleTrading.com. Get in the game.
The Bulls versus the Bears. Get in the game. www.tackletrading.com